do you look at the cycles of investment versus underinvestment in particular sectors, like let's say energy or metals, and how that ends up affecting how those businesses are run and how that ends up affecting their growth, their income, their bottom lines?
Yeah, well, I think for a lot of, particularly for resource-oriented companies, there is a sort of natural super cycle when it comes to investment and production, and a big reason why that is that the lag times are just so huge, so long, right? From the point in which you break ground to the point in which you receive production. In some cases, it can be 10 years, right? From the starting to the permitting process to the point in which metal is coming out of the ground. And so in that sense, the supply dynamics are relatively fixed and relatively well known ahead,
Mhm.
and undulate with a 10-year lag. Whereas demand, it goes up and down, it moves with the business cycle, which is a much shorter oriented cycle. And so that creates a big mismatch between the projected production and the demand, sometimes on the upside, sometimes on the downside, right? Sometimes there's way too much supply relative to weak demand. Sometimes there's not nearly enough supply. The reality is we went through, 15 years of very weak commodity prices. Really, I mean, commodity prices basically peaked at, just before the financial crisis, and have been, were soft. Like CRB was basically soft for 15 years afterwards, and only recently started to get close to where those tops were back prior to the financial crisis, which has then meant that there's been basically no investment, no investment in supply, which means that, now today we're living in the resource world based upon the investments that were decided 10 or 15 years ago when prices were falling, which means we don't have enough supply relative to the investment, which is the type of circumstances that create a squeeze on prices, and create that sort of super cycle higher. And so I think we're sort of, in the grand scheme of things, early in that super cycle rather than later in that super cycle, given the shifts in demand that have occurred across a lot of different assets. And when you look at these things, we talk about orange juice, we could talk about copper, we could talk about cocoa, we could talk about all these things as if they're idiosyncratic things. And of course, there's idiosyncrasies in each one of them. But it's important not to lose sight of the fact that there's a structural story here, which is that, basically bad price performance for 10 years in commodities has now led to a dynamic where we're having much better price performance in the future.
Mhm. Yeah, and I think the important part is being able to kind of see that coming. That ends up being, your edge in finding those markets and those opportunities, right?
For sure, yeah. And I actually like, I mean, the commodity markets are, I find, to be a rich source of alpha, um, because they often play in these sort of nice, concrete, long cycle dynamics. So if you can understand the supply cycle dynamic and then, get the macroeconomy demand side right, you can actually, you can do a pretty good job there, in terms of understanding what the price moves are going to be. And, big picture is, those things are signaling higher prices ahead, not lower prices ahead, which, if we go back to our inflationary story or inflation conversation, that's, they're not the only driver of inflation. We already
Mhm.
talked about how services are such an important driver, but it's certainly a driver that will likely be a positive support to inflation over the next 10, 15 years. Whereas before, what we saw the last 10 or 15 years was a negative pressure on inflation from.
Mhm. And I think kind of going back to our other conversation about removing risk, I think that that also has a role to play in being able to take risk off the table for making those types of investments as well.
Yeah, for sure, for sure. That's a very important part of the story.
Yeah, absolutely.